Yeah, it's overcompensating. This is like behavioral at this point. They know how late they were. They know what they've unleashed by not acting sooner, by continuing to stimulate long past the point where we had massive recovery in markets and in employment. They know what they did. So this is like a combination of, hey, let's earn back our credibility. And, I get it. I'm not opposed to what they're doing, but I completely agree with Ian. Shut up already. We got it. We get it.
But I mean, the minutes, right? We're finding out sort of what's really happening in the room and in their heads, right? Appropriate at some point to pause rate hikes, excuse me, they say. But many in the room saw the cost of doing too little outweighing too much. And a sizable portion of the economy is yet to respond to the rate hikes. I'm curious to your reaction to these minutes, right? Especially the line of seeing the cost of doing too little outweighing the cost of doing too much.
Well, look, the thing about what they want to do is you're not really going to have concrete evidence that it's worked until months after the fact. And you're not really going to know what the ramifications are and the unintended consequences of moving this quickly, this aggressively, until long after the fact. That's just the nature of these things, and the Fed can't do anything about that. So, we want to get to 4.5% unemployment. We think that's more reasonable. Okay, so that's 1.1 million, 1.2 million jobs lost. How fast do you need to bring that about? You need to bring that about this month. So a lot of the things that the Fed needs to have happen are going to lag what they're doing. Like, this is just the way it works. I know they know that too. So that's the game that we're playing right now, and it's not pleasant.
But give me the scoop on earnings, okay? So that's where you sort of threw the dice down here on what's going to happen, right? We really kick it off on Friday with the banks, and then it gets hot and heavy in the weeks ahead. What should we expect? Is it enough to, quote unquote, save the day? You got the Fed overhanging everything. So, I mean, the numbers almost feel like irrelevant. The guidance is more important than anything else.
It's a very perverse situation. We want layoffs, and we want caution on these calls, and we want to hear companies retrenching. Like, I know it's very counterintuitive, but that's what we want, and that's what we're going to get. This is Yardeni data. Q3 earnings are expected to be up 2.9% year over year. The projected growth rate from this past January going into the year was 7%. So we've already lopped off more than half of the earnings growth that was being expected for this quarter. They're also taking down Q4 numbers. Now they think up 6 and change percent. That number was closer to 14% at the beginning of this year. So that work is being done by Wall Street's analysts. You could argue that they should be doing it quicker, but Q2 earnings didn't justify ratcheting down expectations that much more quickly. So it's a very tough situation. And then you've got companies like Pepsi, where they're basically like, hey, we're fine. FX headwinds, blah, 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 we're okay. So it's really, really tough to envision a scenario where those numbers drop really quickly. But that will be evidence for the Fed that they're getting their way. One of the main things I want to get to really quickly, Scott, is this. We're getting the question from our client. We do a quarterly conference call, and we say, send us your questions. What do you want to hear about from us? And then myself and Barry and Michael and Ben and the whole gang weigh in. The number one question that we're getting is, if you know that earnings are coming down, why would you want to be invested? And we took that question and we ran the numbers, and this was fascinating. And I don't think the viewers have heard this anywhere yet. If you go back from 1930 through 2021, S&P 500 corporate earnings were positive 61 years, negative 31 years. So about a third of the time, earnings are down from the previous year. If you only invested in the stock market during those years where earnings were up, your returns would have been 10.2%. If you only invested in the years where earnings were down, you would have made 9.8% on average. So identical. So the path of earnings doesn't necessarily tell you what stocks are going to do in any given calendar year. So yes, we know earnings estimates are too high. They are coming down, have been coming down all year. That will continue. But that doesn't necessarily translate into a sell.